Hello and welcome to the Signia Market Review for November. My name is Gregoire Sharma and I'm the Fixed Income Fund Analyst here at Signia. Markets in November were driven by risk-off sentiment as news of the latest COVID-19 variant and increased hospitalizations in Europe led to fresh mobility restrictions to try and curb the spread of the virus. Apprehension about the new Omicron variant in particular saw volatility surge higher towards the end of the month. Risk sentiment was also shaken due to concerns that persistently high inflation rates could accelerate monetary tightening. Investors sought shelter in safe haven assets over risky assets, which helped global sovereign bonds rally. Equity market indices generated negative returns in November on the back of the virus mutation developments. In relative terms, the US outperformed other developed market regions during the month. European, Japanese and UK markets all performed significantly worse, falling further in light of the new variants as they all have a greater proportion of companies more exposed to the global economic cycle. European equities in particular suffered this month due to the fresh restrictions imposed across the continent. Looking at global sector performance, cyclical sectors underperformed defensive sectors on the back of weakening risk sentiment. Energy and financials generated the worst returns this month, while the travel and leisure sectors were particularly weak as international travel restrictions were reintroduced in response to Omicron. Inflation indices in the US, Europe and the UK remained elevated this month, which saw central bank rhetoric turn increasingly hawkish. In the US, Federal Reserve Chair Jerome Powell announced tapering could be accelerated, seemingly shifting from the transitory inflation view to the more permanent inflation view of financial markets. In addition, expectations of sooner than expected rate increases have been pushing short-term yields higher. In November, the spread between the US 10-year yield and the 2-year yield flattened by 15 basis points, a combination of short-term yields rising and long-term yields falling on the back of lower growth expectations and investor demand for safe haven assets. Risk-off sentiment also affected spread sectors with mixed results for corporate credit indices. Investment-grade credit outperformed high-yield credit thanks to its higher interest rate sensitivity as interest rates fell on the month. Spreads in high-yield credit widened significantly towards the end of the month on increased market volatility. Emerging markets dollar sovereign debt suffered this month on the back of the US dollar strengthening and general risk-off sentiment. Weakening EM currencies created additional woes for emerging market local debt, especially in Turkey, where the central bank surprised markets by cutting interest rates in a bid to spur investment and boost economic growth as directed by President Erdogan's economic policies and despite soaring inflation. Turning to alternatives, oil prices collapsed following the announcement by the US and a number of other countries about releasing strategic oil reserves and again following the latest variant news. That's it for the month. Thanks for listening and see you in the new year.